For more on the auto industry, let's bring in a voice we know well. Mark Fields is former president and CEO of Ford. He's also currently a senior advisor at TPG Capital. And Mark, it's great to see you. Thank you for joining us today.
Thanks, Becky. Great to see you.
Let's talk a little bit about what the big three are facing at this point. March was a huge disaster in terms of sales. You've got people being ordered to stay at home, and that's got to put massive pressure on the sales. And then you have what's happening on the production lines, too. What's your take?
Well, you saw this is all about consumer confidence right now. What started out as a supply chain issue when this virus started in China has now turned into a full-blown demand issue. And so what you saw in March, obviously, with the shelter-in-place orders, the industry came in, I think, at about 11.4 million units. That's the lowest since, I think, July of 2010 when the industry was getting back on its feet. And that's really just the consequence of surging unemployment, obviously the decline in consumer confidence, and the volatility in the stock market, because the bottom line is most folks that are buying new cars are more wealthy folks who happen to have brokerage accounts. And when you look at your brokerage account, your first instinct is to run for the liquor cabinet. The last thing you're thinking about is buying a car.
Yeah, we had Steve Leisman on a little earlier with us, and he was talking about how economists are kind of predicting a real sharp V, up-shape, maybe not a straight V, but a very sharp rebound in economic activity in the third quarter at this point. But I guess that depends on a lot of different factors, the most obvious being how long these stay-at-home orders are issued, what happens with the coronavirus. But then, as you point out, consumer confidence, too. What would your estimation be in terms of what the recovery looks like for the auto sector?
Well, anybody that's giving you a forecast right now, you really can't rely too much on it because we don't know. It all comes down to our ability to manage and ultimately come up with a vaccine for this virus. But when you look back over the last 5 or 6 years, what has really driven the strength of the car market here in the U.S. and kept it over 17 million units are low interest rates, affordable interest rates, low unemployment, and wage and income growth. And if you look at where we are today and going forward, you will have very affordable interest rates at 0%. Can't get much more affordable than that. But until you start seeing the unemployment starting to come down as people come back to work, and you start seeing some wage growth again, I think you'll see that the car industry will need some impetus to get there. Back in the Great Recession, we partnered with the government for what was known as a cash for clunkers incentive to get older vehicles off the road. That provided the industry a very good bounce, although there was a bit of a payback when you pull forward that kind of demand. But it's those type of things that might be necessary to get the industry up and running. And to put it into perspective, I mean, Phil was talking earlier about the airline industry. The auto industry employs twice as many workers, and as a percent of the GDP, contributes much more than the airline industry. So that puts into perspective how important this is for the American economy.
Do you think another bailout is going to be necessary for the automakers?
No, not necessarily. I think when you look at the automakers, particularly here in the U.S., Ford and GM and Chrysler, they're in much better financial health. I know at Ford we worked very hard to build a very strong balance sheet. They have plenty of liquidity that will, literally allow them to function with 5 or 6 months without any production. I don't think that will happen. But nonetheless, it's really about the supply base, and it's about liquidity throughout the supply base. And you have a very strong big suppliers who are in the same situation, I think, as the OEMs with good balance sheets. But it's really the smaller, what they call the Tier 2 through Tier 4 suppliers, who are really going to come into a crunch because right now they're living off the receivables that the automakers are paying them from past work. When it comes time to bringing these production lines back up, they need to front the cost for bringing the workers back, paying the materials, paying for the logistics. And so I think in the next 30 to 60 days, they're going to need some help.
Mark, the other question I get frequently asked is, what about the dealers themselves? That they have a lot of inventory that's going to be sitting around. A lot of them don't have the deep pockets that some of the big three have at this point. What happens if some of those dealers go out of business? Does that impact the big three further down the road?
Well, not necessarily. The automakers are always looking at their dealer network and working with them to make sure they have the right coverage. But, dealers are they're the backbone of the auto industry here in the U.S. and around the world. They're small businesses. They're struggling with many businesses, the fact that the business has gone from 100 miles an hour to zero. They're very important. And what you're going to see is these actions that the federal government has taken through the CARES Act will help them, but you are going to see some consolidation in the dealer industry. But many of them are still open, right, for maintenance only because of servicing police vehicles and fire departments and emergency service type of vehicles, ambulances. But they're under stress right now. A lot of them are taking advantage of the CARES Act, but there will be some consolidation going forward.